Guys, I mean, ITC has been testing the patience for investors for almost a year now. And the problem is, people like ITC because, as you can see here, it has a massive size of 2.62 lakh crore rupees. It has high free-flowing cash-generating abilities, which is something we all want from a company. It's also the cheapest FMCG mainstream company. So here I can see the PE is currently at 19.7, but if you see other FMCG companies like Nestle or HUL, they're much higher. But despite all this, ITC has underperformed Sensex by 5% over the last 10 years and a massive 32% in just 2021. So I'm here to clear some doubts. Why the hell is this happening, and what are the top 5 reasons of why ITC is probably sideways? So the first problem with ITC is that it has a high dependence on its cigarette business. That is its cash cow. So the ITC was called the Imperial Tobacco Company, then it later changed to the Indian Tobacco Company. It was the vision of late Shri Y.C. Deveshar to turn the portion of cigarettes business from 80% and reduce it to only 20%. So the business is diversified. However, even after 20 years, even today, 84% of ITC's EBITDA comes from the cigarette business. But why shouldn't the cigarette business grow? It has a 75% EBITDA. That's unbelievable. Some of the best technology companies which are known for scaling have that kind of margin. On top of that, ITC owns 80% of the organized business. It's a leader with high margin, which means that's a double thumbs up for investors. But this seems like a good thing for a big company. It's actually not. It needs to diversify and get income from different sources, ideally which are unrelated. So if something happens to the cigarette industry, ITC will really be affected. So large companies generally diversify into different products, different sectors. They could be connected loosely, but they are different and diversified. And that's the problem with ITC. Now the cigarette industry is highly regulated, and over the last 5 years, you'll be surprised to know, taxes have gone up from 45% to 56%. Now we all know that consumers of cigarettes generally keep increasing. But that's not happening with ITC. Since the price has been going up over the last 5 years, the volume of these cigarette sticks has stagnated. Look at this chart. You'll see FY15, there's a big drop. Then from FY16 all the way to 20, there's not really much happening. It's sideways. The volumes have stagnated. And it's not that people have stopped smoking.
अरे नहीं ब्रो, मैंने छोड़ दिया.
But people have moved to cheaper, unbranded, illegal cigarettes. And that's where the sales are happening. So the market's the same, but people aren't choosing ITC cigarettes because, well, they're more expensive. In fact, I can actually prove it. You can see in this chart legal versus illegal volumes from 2005 all the way to 2019. You can see as the taxes grew on the legal cigarettes, the illegal ones looked cheaper to the consumer and the consumption for illegal ones increased. And this is obviously affecting the organized sector, hence ITC. The second problem is excessive diversification leads to diversification. I mean, ITC's business is way too diversified. I even have a list over here. Food products, personal care products, soap, shampoo, clothing stores, cigarettes, agarbattis, notebooks, hotels, paperboard, packaging, B2B businesses like trading, agriculture products, and it's also in information technology. I don't understand why ITC would go into IT. It makes no sense.
भाई साहब कुछ ज़्यादा नहीं हो गया ये? मतलब कुछ भी।
इस कंपनी को कंपनी क्यों बोलते हैं, इसको इंडेक्स घोषित कर देना चाहिए।
एक बात बताओ, इस घर में कितने परिवार रहते हैं?
15-16 परिवार।
हाँ, तो इसको घर क्यों बोलते हैं? इसको जिला घोषित क्यों नहीं कर देते?
Now, you see, the problem with diversification is that first you should go into businesses you can dominate, not just because you have to open another business. One thing about good capital management is that any good capital allocator won't allocate money from a high ROCE business to a low ROCE business. For example, cigarettes is extremely high, and moving businesses into low ROCE businesses like B2B agri trading, information technology, or even hotels does not make good money management sense. The third point is the hope that ITC's non-cigarette FMCG business will grow. So the FMCG sector in general is always rewarded with high PE. Generally, you'll see that the Nifty FMCG has outperformed Nifty. For example, we can see 26% versus 14% is the performance over the last 10 years, which is not bad, right? And it should be, because FMCG generally has zero debt. A lot of companies have very low debt, have a lot of free cash flow, and enjoy a very high margin because their brands are very strong. Speaking of margin, let's understand what ITC's non-cigarette FMCG margins are. You'll see here that it's only 7%. And when you compare that with Colgate or Imami, which is in the 27, 26, 24% range like Nestle, that is a huge problem. Now, generally, ITC tries to merge its non-cigarette and cigarette business together and show a high margin, but we've separated this to just remove cigarette and just look at FMCG without the cigarette in it. One problem with the product portfolio of ITC is that 30% of the product is in things where you cannot have high margin. For example, Atta and other staple products are low margin products where you can't charge a lot because your brand is good. So they will actually have to change the product mix for this 7% to become a 15, 20, 25%. Number 4, the hotel business is a pain. I know it looks ultra luxurious and beautiful when you see an ITC hotel. And it probably helps in India's tourism. When people come, then they can stay in our crowning jewel, one of which are ITC hotels. But the problem from an investor's perspective is returns. See, one way to measure returns of capital allocation is using ROCE, which basically measures how much money was put in and how much return we got after plowing in that money. Now, ITC has spent a lot of money. They have pumped in a lot of cash to make the hotel's business possible and actually grow. But let's look at it from an ROCE perspective. You'll see here that in FY16 all the way to 20, the EBIT has increased from 60 crores all the way to 150 crores, which is a good thing. But look at the capital employed and then the pre-tax ROCE. The pre-tax ROCE means the return over the capital that was employed. And you'll notice it's 1%, 2%, going as high as 2.79% a few years ago. I mean, compare that to the cash cow cigarette business, it's much, much higher. So when a company allocates money and continues to pump into such a low ROCE business, you kind of think, why are they allocating capital in such a bad way? They shouldn't be doing this. Point number 5 is the shadow over ESG compliance. Now, ESG funds are funds which invest in companies that are environmentally, socially, and governance conscious. This means that if a company is polluting the environment, it will not be included in the ESG portfolio. So this trend is fast catching up and billions of dollars are going into ESG companies. This means for ITC, which generates over 80% of its EBITDA from cigarettes, will be completely screened out, and those ESG funds won't invest in an ITC. So you as an investor, what events should you look forward to make sure that ITC moves in the future? So I've compiled a list. The first one is the demerger of the non-cigarette FMCG biz into a separate entities. This would result in massive value unlocking because a lot of ITC's financials get diluted because of other non-performing businesses. If the entities are separate, the financial ratios and growth potentials just look a lot better, especially if it's just selling cigarettes as a separate entity. There's also something called conglomerate discount, where people give a discount over conglomerate over a specialized company. So if they're separate entities, they actually hold slightly more value in view of professional investors. Another thing you should be looking at is what if ITC sells its non-core businesses? This could be massive value unlocking. Imagine ITC trying to sell its hotels business, its paper or agri trading. Not only would have they gotten rid of non-performing assets, they would have also got an influx of money coming in, which they can allocate, hopefully, into other better businesses. The third thing that could influence is a management change. So a lot of the upper management of ITC have been working for many years, and sometimes a company just need a fresh perspective, a new perspective to try something new. So if there is a change of upper management, that could be a trigger to actually change the vision and the direction with which ITC is moving forward. Tata Consumer Products, Capital First, Bajaj Finance, and many more have followed something similar. An outsider perspective is sometimes needed if there is a stagnation in the business. And one last disclaimer, guys, I'm not saying ITC is good or bad, simply try to present information to you that hopefully we can all use to improve our analysis skills and understand ITC a little more better. If you want to learn fundamental analysis in deep, or maybe want to learn investing, you should check out these courses over here. There's a link in the description. I'm sure you will love. The first topic in all these courses is free, so you should definitely check it out. If you guys have any suggestions on what we should cover next, put it in the comments below, and please like and subscribe because that's the only way we know that what we're doing is good and we can keep making videos. See you in the next video.